Topic examines capital structure theories and explains how firms determine the optimal mix of debt and equity financing. Capital structure decisions are important because they influence a company's cost of capital, financial risk, profitability, and overall market value. Managers must balance the advantages of debt financing, such as tax benefits, against the increased financial risk associated with leverage. The topic explores several theories explaining how financing choices affect firm value under different assumptions regarding taxes, bankruptcy costs, information asymmetry, and managerial incentives. Understanding these theories helps analysts evaluate corporate financing strategies, risk profiles, and long-term financial sustainability. The Modigliani-Miller propositions form the foundation of modern capital structure theory. Under the original Modigliani-Miller framework without taxes, capital structure is considered irrelevant to firm value because investors can replicate corporate leverage through personal borrowing. In perfectly efficient markets with no taxes, transaction costs, or bankruptcy costs, financing choices do not affect total firm value. However, this theoretical model relies on highly unrealistic assumptions. When corporate taxes are introduced, debt financing becomes advantageous because interest payments are tax-deductible. This creates a tax shield that increases firm value as leverage rises. The revised Modigliani-Miller theory therefore suggests that debt financing can enhance shareholder wealth under certain conditions. The trade-off theory expands on the tax shield concept by recognizing that excessive debt also creates costs. While additional leverage provides tax advantages, higher debt levels increase the probability of financial distress and bankruptcy. Financial distress may lead to legal costs, operational disruption, reduced customer confidence, and strained supplier relationships. The trade-off theory argues that firms seek an optimal capital structure balancing the tax benefits of debt against the expected costs of financial distress. At moderate leverage levels, debt financing may lower the weighted average cost of capital and improve firm value. Beyond the optimal point, however, additional leverage increases risk and reduces overall corporate value. The pecking order theory offers another explanation for corporate financing behavior based on information asymmetry between managers and investors. Managers typically possess more information about the firm's true financial condition and growth prospects than external investors. Because issuing new equity may signal that management believes shares are overvalued, investors may react negatively to equity issuance announcements. As a result, firms often prefer internal financing through retained earnings first, followed by debt financing, and issue new equity only as a last resort. According to the pecking order theory, financing decisions are driven less by achieving an optimal leverage ratio and more by minimizing information-related financing costs. The topic also discusses agency costs and their influence on capital structure decisions. Agency conflicts arise because managers, shareholders, and debt holders may pursue different objectives. Debt financing can reduce certain agency problems by limiting excess cash available for inefficient managerial spending and increasing financial discipline through required interest payments. However, excessive leverage may create conflicts between shareholders and creditors because shareholders may favor riskier projects that benefit equity holders while increasing risk for debt investors. Effective capital structure management therefore requires balancing financing efficiency with maintaining appropriate incentives and controlling conflicts among stakeholders within the firm's governance framework. Overall, topic demonstrates that capital structure decisions involve complex trade-offs among taxes, financial risk, information asymmetry, and agency considerations. No single theory fully explains all corporate financing behavior, but each provides valuable insight into how firms balance debt and equity financing. The Modigliani-Miller framework highlights the role of taxes, the trade-off theory emphasizes balancing benefits and costs of leverage, and the pecking order theory explains financing preferences under information asymmetry. For CFA candidates, understanding capital structure theories is essential because financing decisions affect valuation, profitability, risk exposure, and shareholder returns. Strong capital structure analysis therefore supports more informed corporate finance evaluation and investment decision-making.